Let's be real. If you haven't saved up $30,000, most people will tell you not to even try buying a house. And sure, in a perfect world, you'd have a big down payment, closing cost money, and a fully loaded emergency fund. But that's not the world most people are living in. So in this video, I want to show you exactly how I'd buy a house in 2025 if I had nothing saved. I'm talking zero for down payment, zero for closing costs, no money set aside for emergencies, just the decision that I was ready to buy and the willingness to be smart about it. But here's the thing, it can be done. It's not always easy, it's not always ideal, but it's possible. And in this video, I'll show you exactly how I'd pull it off step by step. The first thing I do is check if I qualify for a USDA loan. This is hands down one of the best programs out there for people with no money saved. It's a true zero down loan. That means no down payment. USDA loans also come with cheaper mortgage insurance than most other loan types. It's not insurance for you, it protects the lender in case you default, but you pay for it as part of your monthly mortgage. USDA calls it a guarantee fee, and it's a lot lower than what you'd pay with FHA, which helps you keep your payment down. I have a bunch of videos about the USDA loan, check those out to learn more about all the details. But here's the real reason I'd start with USDA. If you structure the offer right and the numbers work out, it's one of the only loan types where you can actually get into a home with $0 out of your own pocket. No down payment, no out-of-pocket closing costs. Even though USDA doesn't require a down payment, you still have closing costs. Those usually add up to somewhere between 2 and 6% of the home's purchase price. That includes your lender fees, title charges, escrow fees, prepaid taxes, and insurance. All the stuff that's due at closing. So for a $300,000 home, your closing costs could be anywhere from $6,000 to $18,000. But a lot of people don't realize the seller can actually pay some or even all of those costs for you. With a USDA loan, the seller is allowed to contribute up to 6% of the purchase price towards your closing costs. So let's say you're buying a home for $250,000. You could ask the seller to pay $7,500 towards your closing costs. If they agree and your offer is structured well, that could cover everything. Now here's the part most people miss. If the home appraises for more than the purchase price, USDA also allows you to roll your closing costs into the loan up to the appraised value. So if you're under contract for $250,000 and the home appraises for $255,000, you could roll $5,000 of those costs into your loan. But I wouldn't count on that happening. Appraisals can come in low or right at purchase price, so I'd always try to negotiate seller paid costs first and consider the appraisal flexibility a bonus if it works out. Now this strategy doesn't work in every market. If you're competing with 5 offers, the seller probably won't pay your closing costs. But in 2025, we're seeing more price cuts, more seller concessions, and more homes sitting on the market longer. That opens the door for this kind of offer. You can check out my website, workwithdang.com, for free home buying resources like a mortgage calculator, quick start home buying guide, and a homebuyer's course. I can help you find a real estate agent in your area. There's more information on my website. I make content like this every week. Please subscribe if you haven't already. If USDA wasn't an option, maybe because the area I'm buying in isn't eligible or my income is above the limit, I'd shift gears and look into down payment assistance programs. And more than likely, you'd want to focus on getting an FHA loan and pair that with down payment assistance. With the FHA, it's not zero down like USDA, it's 3.5% down. So if you're buying a $300,000 home, you would need to put down about $10,500. That's where down payment assistance can come in handy. These programs come in a bunch of different forms. Some are grants you don't have to pay back. Some are second loans that get repaid when you sell or refinance. Some are actual second mortgages with interest. You've got programs from city, county, and state housing agencies, and sometimes even ones tied to specific lenders. If I had no money saved and didn't qualify for USDA, that would be my next stop. But I'd go into it carefully, because here's what a lot of people don't realize. In some markets, down payment assistance can actually hurt your chances of getting an offer accepted. The reason is risk. When a seller and their real estate agent see a down payment assistance loan, they often assume the buyer doesn't have cash. And that's not necessarily wrong, but it signals to the seller and the listing agent that the deal might be more complicated, especially because in many cases, down payment assistance is essentially a second loan. You have to get approved for both the main loan, like FHA or conventional, and the assistance program. And sometimes people qualify for one and not the other. That's the kind of uncertainty that sellers want to avoid. It can also stretch out the closing timeline or trigger more paperwork, and that makes some sellers nervous. That doesn't mean these programs are bad, it just means you have to be strategic. I'd talk to a lender who works with these programs regularly, not just someone who offers them once in a while, and I'd compare the terms side by side with other options. If you're trying to buy a home with zero down, it's really important to work with a lender who's knowledgeable about these programs and can help guide you through the process. You may need to reach out to a few lenders to find one that's going to work for your situation. Some down payment assistance programs let you cover the entire down payment and closing costs. Others only help you with one or the other. Some have income limits or require you to be a first-time homebuyer or other requirements. There's literally thousands of these programs, so the qualifications for each will vary. I'd also ask if combining down payment assistance with FHA or conventional would still allow me to ask for seller-paid closing costs, or if there are any limits on how the money can be used. This can work, but you need the full picture about the program you're using. I'd want to know exactly how much it costs per month, whether it has to be repaid, and whether it puts my offer at a disadvantage. Now, this one isn't going to apply to everyone, but if I had a sibling, parent, or close friend who was willing to help, even with just a few $1,000s, I'd absolutely accept gift funds. Most loan programs allow gift money to be used toward down payment and closing costs, as long as it's a true gift and not a loan. But there is one thing I'd want to check. If I am also using down payment assistance, not all programs allow you to combine gifts with assistance. Some have restrictions, or they may require the gift to be applied in a specific way. So if someone was willing to help me out, I talked to my lender upfront to find out exactly how the gift can be used. And I want to say this, I know asking for help can feel uncomfortable, but if it's between getting into a home now or waiting 2 or 3 more years while rent keeps climbing, even a small gift like $3,000 or $4,000 might be the missing piece that makes everything else come together. Regardless, make sure you communicate with your lender, let them know where you're hoping to get your down payment and closing costs from, and they can tell you what's possible and what's not. For instance, you may not be able to use seller credits for the down payment for an FHA loan, but you can use seller credits for the actual closing costs. Because again, I'm walking you through how I do this with nothing saved. That means every dollar matters, and I need to protect myself from surprises. That might be the most important mind shift of all. If I had no money saved, I wouldn't be shopping for my dream home. I'd be looking for a clean, safe, move-in ready starter home, something I could afford. I'd focus on smaller homes that might be a little dated but well maintained, homes in growing neighborhoods just outside the hot areas, and listings that have been sitting for a few weeks or a few months where the seller might be open to offering seller credits. I'd absolutely avoid fixer-uppers, not because they're bad, but because when you have no savings, surprise repairs can wreck your finances. A new roof or a broken AC can cost thousands of dollars, and that's the last thing I'd want in the first year of homeownership. I'm assuming if you're looking to buy a home with zero money down, you didn't just wake up one day and decide, hey, I think I'll buy a home with no money down. More than likely, an event happened in your life, like a landlord not renewing your lease because they're going to sell their home or something like that, and you have to move and you didn't plan for it. So that's why you don't have any money saved up. I wouldn't necessarily recommend buying a home with zero savings, but life happens, and I'll talk about some of the issues to watch out for soon. That brings me to something a lot of people don't factor in, the home inspection. Even if I'm using a zero down loan, I'd still need to budget around $400 to $600 upfront for a professional inspection. That's not something you can roll into the loan typically. It's due when the inspection happens, usually right after your offer is accepted. If money was tight, I'd plan ahead for that, and I'd absolutely get the inspection. Once you buy the house and there's no landlord to call, I'd rather walk away from a bad deal than get stuck with a lemon. If you're concerned about how much an inspection might cost, talk with your real estate agent so they can give you a good idea how much it would cost in your area and for the type of home you're looking to buy. Sometimes if your home has a well or a septic tank, you might need to get those inspections as well, and that could make things more costly. You also want to find out what other money you may need up front, like money for the earnest deposit or money for homeowners insurance policy. Typically that needs to be paid for up front before closing. It's essential to know exactly how much money you'll need so you're not surprised by any unexpected expenses. If I couldn't get the seller to pay my closing costs and the home didn't appraise high enough to roll them into the loan, I'd ask about lender credits. It can be a game changer when you're short on cash. A lender credit works like this. The lender raises your interest rate slightly, and in exchange, they give you money to help cover your closing costs. So let's say your base rate is 6.5%. The lender might offer to bump it up to 6.75% and use that extra interest to cover $4,000 or $5,000 of your costs, for example. Now, is this the best financial move long term? No. You'll have a higher monthly payment and pay more in interest over the life of the loan. But if it's the difference between being able to close or having to walk away, it's worth asking about. And if rates drop later, your credit improves, you can always refinance. Just remember, refinancing isn't free. You'll hear people casually say you can always refinance later, but it's not always that simple or cheap. Regardless, if I had no money saved, I'd rather close the deal with a slightly higher interest rate than miss the opportunity completely. Just because you can buy with no money saved doesn't mean you should, unless you've thought through what happens after closing. If I were doing this, I'd be asking myself some honest questions. Do I have a stable job and steady income? If something breaks in the house, do I have a credit card or family member I could lean on temporarily? What is my plan to save money for repairs and maintenance on the home? How quickly can I save up those reserves? Homeownership is amazing, but it can be very costly. Is the home truly move-in ready, or am I going to have to spend more money right away? Because once you close, the house is yours. If the water heater dies or the roof leaks, it's not the lender's problem, it's yours. That's why I tried to build in even a small buffer. Maybe I hold off on buying furniture or doing any upgrades for a few months. I'd want to at least have a plan for the unexpected, even if I don't have the savings yet. That's the part most lenders and agents don't talk about, but I will. Assuming I pulled this off and bought the house, my job wouldn't be done. I'd start working on a safety net the minute I moved in. That means keeping my lifestyle tight and putting any extra money into an emergency fund. I'd aim to save $2,000 to $3,000 as quickly as I could. That's enough to handle most small repairs or surprises. I'd also consider getting a home warranty. They're not perfect and they don't cover everything, but for a few $100s a year, they can buy you peace of mind during the first year of homeownership. Sometimes you can ask your real estate agent or the seller to buy the home warranty the first year. Buying with no money is a short-term move, but it needs to be followed up with a long-term plan, or you risk ending up being house poor and stressed out. That's not what we're trying to do here. Another issue with this strategy is when you buy with no money down or not a lot of money down, that means you don't have a lot of equity in the home. Equity is essentially the amount of home you actually own. So if something were to happen and you needed to sell the home, if you didn't have a lot of equity, that means you might not make a profit on the sale of the home, or in a worst case scenario, be underwater, meaning you owe more than what the home is worth. I can't say this enough. This is not the best strategy to use. It's risky, but sometimes we find ourselves in a situation where this might be our only option. In a perfect world, I would say you should put 20% down on a home and get a conventional loan. But that's not reality for everyone. So if I had no money saved and wanted to buy a house in 2025, here's exactly what I'd do. I'd start by checking if I qualify for a USDA loan. If I did, I'd ask the seller to cover closing costs, and I'd look for homes where that's realistic. If USDA wasn't an option, I'd explore an FHA loan and down payment assistance, and I'd make sure I fully understood the terms. If someone offered me a gift, I'd use it, and I'd check if that gift could be combined with other programs. I'd keep my expectations grounded, avoid fixer-uppers, and plan for at least the cost of the inspection upfront and any other money I might need. I'd ask about lender credits if I was still short, but I'd think hard before closing with zero reserves. And if I did move forward, I'd build a safety net right away. Buying a home with no money saved isn't easy, but it's doable if you're prepared, if you understand the trade-offs, and if you have a clear plan for what comes next. Check out this video to learn how to buy a home step by step. Please like, comment, and subscribe. It motivates me to make more videos.